It always starts with a party. Not the kind with red cups and bad playlists, but the kind where billion-dollar deals are signed in oak-paneled boardrooms while champagne flows in crystal flutes. Wall Street in the early 2000s was buzzing, stock markets soaring, bonuses breaking records, and bankers bragging about their Hampton summer homes like kids showing off Pokemon cards. But here's the twist. The party wasn't built on solid ground. It was built on mortgages. Yes, those boring monthly payments you make so you can live under a roof and not in your car. Except these weren't your grandma's mortgages. They were mortgages for anyone with a pulse. Bankers had invented a new business model. You get a loan, everybody gets a loan. Oprah would have been proud. Picture this. A guy with 2 jobs, neither paying much, walks into a bank. He's asked, "Can you pay back a $500,000 mortgage?" He shrugs, "Probably not." Banker, "Perfect. Sign here." That's what was happening. They called them subprime mortgages, but that's just Wall Street speak for loans to people who almost certainly can't pay them back. Now, you'd think that was bad enough, but here's where Wall Street showed off its dark genius. Instead of saying, hey, maybe this is dumb, they bundled these risky loans into giant packages called mortgage-backed securities. Then, like kids rewrapping a rotten sandwich in fancy paper, they slapped a shiny label on them, AAA safe. Credit rating agencies, supposedly the referees of finance, played along. It's like if Rotten Tomatoes gave Sharknado 3 a 98% fresh rating. Investors worldwide ate it up. Pension funds, foreign governments, even small-town banks in places like Norway, they all bought these securities, believing they were as safe as U.S. Treasury bonds. Why wouldn't they? The packaging said, no risk, and the returns were juicy. More return, less risk. It sounded like financial alchemy. Spoiler alert, alchemy doesn't work.
Meanwhile, on the ground level, the housing market was going wild. Ordinary families who never thought they could buy a home suddenly became homeowners. House prices skyrocketed. If you bought a house in 2003, by 2006, you looked like a genius. People bragged about flipping homes faster than pancakes. Reality shows popped up where couples bought fixer-uppers, slapped on granite countertops, and sold them for a fortune. The American dream was now the American get-rich-quick scheme. And Wall Street? They were minting money. Banks like Lehman Brothers, Bear Stearns, and Merrill Lynch were raking in billions. Traders strutted around in tailored suits, betting fortunes on housing derivatives with names so complex they sounded like IKEA furniture. Collateralized debt obligations, or CDOs for short. These things were supposed to spread risk, but in practice, they were like tying all your lifeboats together, so if one sank, they all sank. Brilliant, right? Of course, there were warnings. A few voices in the wilderness. An economist here, a hedge fund manager there, muttering that the math didn't add up. But who wants to be the buzzkill at a party where everyone's making millions? It's hard to convince people the ship is sinking when the buffet is still open. And the culture? Oh, it was toxic gold. Bankers bragged about ninja loans. No income, no job, no assets. That's right, you could walk in with nothing but a name and still walk out with a $500,000 mortgage. The logic was simple. Housing prices only go up. If borrowers couldn't pay, they'd just sell the house for more than they bought it. What could possibly go wrong? By 2006, U.S. homeownership was at an all-time high. Suburbs sprawled like kudzu. Construction cranes dotted skylines. The economy looked unstoppable. Politicians patted themselves on the back saying, America's cracked the code to endless prosperity. But behind the curtain, the gears were grinding. Mortgage delinquencies were ticking up. The riskiest loans were already souring. Banks kept packaging and selling them, desperate to keep the gravy train going. It was a giant Jenga tower, and someone had just pulled out the first wobbly block. Still, the music played on. Bonuses flowed. Stock prices soared. Champagne corks popped. Wall Street had convinced itself it was invincible, untouchable, too smart to fail. And then, like every good party, it was only a matter of time before the hangover hit.
The first cracks didn't sound like explosions. They were whispers. A foreclosure here, a mortgage default there. Local newspapers wrote about families losing homes, but it looked like bad luck, not a national crisis. Wall Street executives kept smiling, sipping their lattes in Midtown, while analysts shrugged. The market's strong, don't panic. But panic has a way of sneaking up on you. By late 2007, those mortgage defaults were snowballing. Entire neighborhoods, especially in places like Nevada, Florida, and California, looked like ghost towns. Streets lined with for sale signs, empty swimming pools collecting leaves, families packing up U-Hauls in the middle of the night. The so-called American dream was being repoed, one house at a time. Investors who had stuffed their portfolios with those safe mortgage-backed securities started to notice something. Their supposed gold bars were turning into lead bricks. The numbers didn't lie. Billions in value were vanishing. Imagine checking your bank account one morning and seeing that half your money evaporated overnight. That's what was happening on a global scale. And then, bam, Bear Stearns. In March 2008, the fifth largest investment bank in the U.S. suddenly announced it was out of cash. This was a 90-year-old Wall Street titan, a name synonymous with swagger. Now it was begging for a bailout. The Federal Reserve brokered a shotgun wedding with J.P. Morgan Chase for pennies on the dollar. For Wall Street, it was like watching Superman faceplant. But Bear was just the appetizer. The main course was Lehman Brothers. September 15, 2008, a date etched in financial history. Lehman, a bank with $600 billion in assets, collapsed overnight. Imagine the Titanic, but instead of hitting an iceberg, the iceberg was made of bad mortgages, and everyone insisted it was unsinkable until the water was already pouring in. That morning, Lehman employees showed up in suits, only to be handed cardboard boxes. Traders carried out desk plants, family photos, and shattered dreams. One guy reportedly walked out with a gym bag, stuffed not with sneakers, but with whatever dignity he could salvage. On live television, Wall Street's most iconic name was gone, and the panic? Instant. The global financial system is like a spider web. Tug one thread, and the whole thing trembles. Lehman's collapse froze credit markets. Banks stopped lending to each other. Why? Because if Lehman could go under, who was safe? Suddenly money, the oxygen of the economy, stopped flowing. Businesses couldn't borrow. Consumers couldn't get loans. Even giant corporations faced cash crunches. Stock markets went into free fall. In a matter of weeks, trillions in wealth vanished. Retirement accounts shriveled. College funds evaporated. People who thought they were middle class found themselves staring at pink slips and foreclosure notices. The unemployment rate surged, hitting nearly 10% by 2009. That's millions of families suddenly unable to pay bills, keep homes, or afford groceries.
Governments scramble. In Washington, D.C., the atmosphere was apocalyptic. Treasury Secretary Hank Paulson, a former Goldman Sachs CEO, literally got down on one knee in front of congressional leaders, begging them to approve a $700 billion bailout package. Imagine a man who once ruled Wall Street reduced to groveling on the carpet. It was desperate, dramatic, and humiliating all at once. The bailout, known as TARP, Troubled Asset Relief Program, was sold as the only way to prevent total collapse. Critics screamed, "Why save the bankers who caused this mess?" Protesters hit the streets. Main Street America felt betrayed. People losing homes saw Wall Street executives keeping bonuses. It felt like justice had been flipped upside down. The guilty rescued, the innocent punished. But without the bailout, the whole financial system might have imploded. Think bank runs, mass unemployment, and a depression worse than the 1930s. Politicians held their noses and signed the checks. Banks got their lifeline. The economy staggered instead of collapsing outright.
Still, the damage was historic. Between 2007 and 2009, U.S. households lost around $16 trillion in net worth. 6 million families lost homes to foreclosure. Global GDP shrank for the first time since World War II. From Iceland to Indonesia, the shock waves spread. Small countries that had stuffed their banks with American mortgage securities went bankrupt. Ordinary people from Athens to Dublin paid the price. And the human stories? Brutal. Families camped in cars, college graduates moved back into childhood bedrooms, suicides spiked, marriages cracked under financial strain. The crisis wasn't just numbers on a Bloomberg screen, it was lives dismantled, one paycheck at a time. Wall Street, meanwhile, learned the art of survival. The very banks that helped cause the collapse not only survived but thrived in the years after. Taxpayer money kept them afloat. CEOs kept their corner offices. The phrase "too big to fail" became both explanation and indictment. If a bank was large enough, it couldn't be allowed to collapse because its failure would drag down everyone else. The legacy? Deep mistrust. People saw the game for what it was. Profits privatized, losses socialized. If bankers won, they pocketed the cash. If they lost, taxpayers footed the bill. That bitterness fueled political movements around the world, from Occupy Wall Street to populist uprisings in Europe. The crisis didn't just reshape finance, it reshaped politics, trust, and the very fabric of society. And here's the kicker. The tools used to fix the crisis, like near-zero interest rates and massive government debt, are still with us today. They saved the system, sure, but they also laid the groundwork for new bubbles and fresh risks. The hangover never fully ended. It just morphed into a dull headache we've learned to live with. So how does history remember 2008? As a cautionary tale of greed, hubris, and willful blindness. A moment when the smartest guys in the room proved dangerously dumb. When families paid for mistakes made in skyscraper boardrooms. And when trust in the system cracked so badly it may never fully recover. In the end, the 2008 financial crisis wasn't just about money. It was about belief. Belief that housing prices only go up. Belief that bankers knew what they were doing. Belief that the system would protect ordinary people. All of those beliefs collapsed, just like Lehman Brothers. And the punchline? Well, the only thing Wall Street really proved in 2008 was their ability to gamble with other people's lives and somehow still walk away with the chips.